This presentation is for Chapter 5, Part 1, the analysis of financial statements. Before beginning the analysis of any firm's financial statements, it is first necessary to establish the objectives of the analysis. The objectives will vary depending on the perspective of the financial statement user, as well as the specific questions that the user expects to be answered in the analysis. Creditors will ultimately be concerned with the ability of an existing or prospective borrower to make interest and principal payments on the borrowed funds on time. Therefore, some of the potential questions raised by the creditor would include: what is the reason or reasons for the borrowing, and what is the firm's current capital structure? How will the new debt affect the firm's capital structure, and how does the debtor expect to repay the debt? Investors typically want to arrive at an estimation of a company's future earnings stream in order to attach a value to the securities being considered for purchase or liquidation. Some of the questions that are most likely to be asked by an investor might include: what is the company's past performance record and future earnings potential? How much risk is there in the firm's existing capital structure, and how successful is the company in relation to competitors in the industry? Management is concerned with all of the questions raised by creditors, investors, employees, the general public, regulators, and the financial press, because these are the users that must be satisfied if the company is to obtain the needed capital to operate. Management will also be concerned with the firm's performance, including strengths and weaknesses, and what changes can be implemented to improve future performance. Financial statements provide insight into the company's current status and lead to the development of policies and strategies for the future. But it is important to point out that management has the responsibility for preparing the financial statements, and the analyst should be alert to the potential for management to influence the outcome of financial statements reporting in order to appeal to creditors, investors, and other users. It is important to note that an analysis of financial statements should include a careful reading of the notes to the financial statements, and it is helpful to supplement the analysis with other information such as that contained in the proxy statements, auditor's report, management discussion and analysis, supplementary schedules, Forms 10K and 10Q, as well as the considerable resources available online. The proxy statement contains information provided to the shareholders prior to the annual meeting and includes information about the board of directors, director and executive compensation, option grants, audit-related matters, related party transactions, and proposals to be voted on by the shareholders. The report of the independent auditors contains the expression of opinions as to the fairness of the financial statement presentation. Most audit opinions are unqualified, which means that the opinion of the auditor is that the financial statements present fairly the financial position of the firm, the results of operations, and the cash flows for the periods covered by the financial statements. Other reports can be issued, such as a qualified, adverse, or disclaimer of opinion, and explanatory language can be added to the unqualified report. Any of these latter types of reports and explanatory language should be reviewed carefully by the analyst. The management discussion and analysis of the financial condition and results of operations is required and monitored by the SEC. Management presents detailed coverage of the firm's liquidity, capital resources, and operations. The material can be useful to the analyst because it contains information not found elsewhere in the annual report, such as forward-looking information of projections and details about the mix of price relative to volume increases for products. Management is required to disclose both favorable and unfavorable trends, as well as significant events or uncertainties related to the historical or prospective financial condition and operations of the firm. Certain supplementary schedules are required for inclusion in the annual report and are frequently helpful to the analyst. Companies that operate in several unrelated lines of business provide a breakdown of key financial figures by operating segment, as will be discussed later in the appendix. Form 10-K is the annual document filed with the SEC by companies that sell securities to the public and contains much of the same information as the annual report issued to the shareholders. It also shows additional detail that may be of interest to the financial analyst, such as schedules listing information about management, a description of material litigation, governmental actions, and elaborations of some financial statement disclosures. Form 10-Q is a less extensive document that provides quarterly financial information. As mentioned previously, there is a wealth of information available outside the annual report, some of which is free on the internet and others through subscription fees or in databases available at public and academic libraries. There are financial statement analysis packages that can perform ratio calculations and other analytical tools. Various tools and techniques are used by the financial statement analyst to convert financial statement data into formats that facilitate the evaluation of a firm's financial condition and performance, both over time and in comparison with industry competitors. These include common size financial statements, key financial ratios, trend and structural analysis, industry comparisons, and just common sense and judgment. Common size financial statements express each account as a percentage of total assets for the balance sheet accounts. For the income statement, each of the accounts is expressed as a percentage of net sales. This is the common size balance sheet from Chapter 2 for Sage Inc. for 5 years. In reviewing the common size balance sheet, we see that inventories have risen to become almost half of total assets, 49.4%, for 2016. The cash and cash equivalents for the company have decreased from a 20% combined level in 2012 and 2013 to about 10% in 2016. The company made this shift to accommodate the increased inventory requirements for its 43 new stores opened over a 2-year period. The effect of this market strategy is apparent in the overall asset structure, as buildings, leasehold improvements, equipment, and depreciation and amortization have all increased as percentages of total assets. On the liability side, the proportion of debt required to finance investments in assets has risk primarily from long-term borrowing. This is the common size income statement as shown in Chapter 3 for Sage Inc. for the same 5-year period. In reviewing the common size income statement, we see that cost of goods sold increased slightly in percentage terms, resulting in a small decline in the gross profit percentage. In the areas of operating expenses, depreciation and amortization have increased relative to sales, again reflecting costs associated with the new store openings. Selling and administrative expenses rose in 2014, but the company controlled these costs more effectively in 2015 and 2016 relative to overall sales. Operating and net profit percentages deteriorated through 2015, but rebounded in 2016. Besides the common size financial statements, there are key financial ratios that are used to standardize financial data in terms of mathematical relationships. They are expressed as either percentages or times and are very valuable in analyzing financial statements, but it is important to remember that ratios have limitations. Key financial ratios are best used as screening devices that can identify areas of potential strengths and weaknesses and reveal areas that require further investigation. They do not provide answers by themselves and are not predictive. Ratios should be used in combination with other information and with a measure of caution and common sense. There is no definitive set of key financial ratios, and there is no uniform definition or particular standard for each ratio. They should be evaluated and interpreted in the context of the history of the particular firm, industry, and with an understanding of the current economic environment. The ratios can be divided into the following categories: liquidity, activity, leverage, profitability, and market. To illustrate the use of the key financial ratios, the balance sheet for Sage Inc. for the periods ending December 31st, 2016 and 2015 as shown will be used. The income statements for Sage Inc. for the periods ending December 31st, 2016, 2015, and 2014 as shown will also be used in the ratio analysis. Also, the statements of cash flows for Sage Inc. for the periods ending December 31st, 2016, 2015, and 2014 will be utilized. Liquidity ratios are used to measure a firm's ability to meet short-term cash needs as they arise. The liquidity ratios that will be demonstrated are the current, quick or acid test, cash flow liquidity, average collection period, days inventory held, and days payable outstanding. The current ratio is a commonly used measure of short-run solvency or the ability of the firm to meet its debt requirements as they come due. Current assets is used in the numerator and current liabilities in the denominator. Some analysts will remove prepaid assets in the numerator because they are not a potential source of cash, but rather represent future obligations that have already been satisfied. As with many other ratios, 1 year is not enough to evaluate the company, but rather the trend of liquidity over a period is needed, as well as comparison with industry competitors. Sage Inc.'s current ratio for the 2015 and 2016 years shows a downward trend. A more stringent or rigorous test of short-run solvency is the quick or acid test ratio that does not include inventory in the numerator but still has current liabilities in the denominator. Inventory is the least liquid of the current assets and frequently can be a source of losses. Again, some analysts will also remove prepaid expenses. The quick or acid test ratios for Sage Inc. again show a downward trend from 2015 to 2016 and should be evaluated in terms of other firms operating in the same industry. The cash flow or liquidity ratio is calculated by adding cash flows from operating activities plus cash and marketable securities divided by current liabilities. Cash and marketable securities, which are the truly liquid current assets, are used as an approximation of cash resources. This ratio represents the amount of cash generated from the firm's operations, such as the ability to sell inventory and collect cash. Sage Inc.'s cash flow liquidity ratios from 2015 to 2016 increased in comparison to the current and quick ratios that decreased. This ratio reflected the return of Sage to positive cash flows from operations in 2016. The average collection period is the net accounts receivable divided by the average daily sales, which is sales divided by 365. This ratio represents the average number of days to collect the accounts receivable and is a measure of the liquidity of the receivables. It should be compared to the company's credit policies to determine if they are being met. For Sage Inc., the average collection period decreased from 20 to 15 days over the 2 years, which indicates that Sage is doing a better job in collecting the amounts due to the firm. The days inventory held is calculated by dividing the inventory by the average daily cost of sales, which is the cost of goods sold divided by 365. This ratio measures the efficiency of the firm in managing its inventory. Generally, a low number of days inventory is a sign of efficient management, as the faster the inventory sells, the fewer funds are tied up in inventory. This figure will vary from industry to industry and should be used in combination with average industry information. For Sage Inc., the number of days inventory decreased from 146 to 133 days, indicating that the inventory was moving faster in 2016. The days payable outstanding is calculated by dividing the accounts payable by the average daily cost of sales, which is cost of goods sold divided by 365. This ratio gives insight into a firm's pattern of payments to suppliers. Delaying payment for payables may be desirable if the firm is meeting terms required by the supplier and can earn a return on cash held. Sage Inc.'s ratio increased from 2015 to 2016, indicating that it is taking longer to pay suppliers in 2016 than in 2015. By combining the average collection period, the days inventory held, and days payable outstanding, you can calculate the cash conversion or net trade cycle. This is a period of time it takes the company to purchase or manufacture inventory with some purchases on credit, sell the inventory with some sales on credit, and collect the cash. This ratio helps the analyst to understand why cash flow generation has improved or deteriorated by analyzing these key balance sheet accounts that affect cash flows from operating activities. Sage Inc.'s cash conversion or net trade cycle ratio has decreased from 135 to 107 days from 2015 to 2016, indicating improvement. But there is still a mismatch between the days needed to sell and collect the receivables, such as 148 in 2016, and the time for payment of the merchandise, 41 days. The activity ratios measure the liquidity of specific assets as well as the efficient management of them. The accounts receivable and inventory turnover ratios measure how many times on average accounts receivable are collected, inventory is sold, and accounts payable are collected during the year. These are mathematical complements to the ratios in the cash conversion cycle and are an alternative way to look at the same information. The fixed asset and total asset turnover ratios are two approaches to measuring management's effectiveness in generating sales from investments in assets. The accounts receivable turnover ratio is a measure of the efficiency of the firm's collection and credit policies. Sage Inc.'s accounts receivable turnover ratio improved from 18.32 to 24.06 over the 2-year period. Inventory turnover measures the efficiency of a firm in managing its inventory, which is critical since inventory is costly to hold. Sage Inc.'s inventory turnover ratio increased from 2.5 to 2.7, indicating that inventory was being sold faster during 2016. The accounts payable turnover ratio measures how many times, on average, payables are paid during the year. It is helpful to identify the payment patterns to the company's suppliers. Sage Inc.'s accounts payable turnover ratio decreased from 12.10 times to 9.05, indicating that it was taking longer to pay its suppliers in 2016. The fixed asset turnover ratio concerns the firm's investment in property, plant, and equipment and is extremely important for a capital-intensive firm such as a manufacturer with heavy investments in long-lived assets. Sage Inc.'s fixed asset turnover ratio decreased from 2015 to 2016, indicating less efficiency in using fixed assets to generate sales in 2016 compared to 2015. The total asset turnover measures the efficiency of managing all of a firm's assets. Generally, a high ratio means only a small investment is required to generate sales, and thus the firm is more profitable. We see that Sage Inc.'s total asset turnover improved from 2015 to 2016, indicating that there was increased efficiency in using total assets to generate sales in 2016. This is the end of the presentation for Chapter 5, Part 1, the analysis of financial statements.